Welcome to the Broken Pie Chart Podcast, episode 344. I'm your host, Derek Moore. Back with me is Mike Syder and Shane Skinner this week. Okay, just pulled it up. What are the probabilities, based upon the prediction market, of the U.S. government shutting down in 2025? Gentlemen, it's 80% on, I don't know which Polymarket and WSL predict, according to Bloomberg. All right, Shane, you were talking about this off air. So yes, if there are certain government workers, this would affect them. Now, I'm going to tell you, usually these are short-lived, even if they happen, and it's not too much of a market event. But Shane, you were bringing up something because you are kind of doing some stuff with a house. What did you find out?
Yeah, so today in my closing on a house, I was essentially told by my realtor that if this government shutdown happens in October, say on the 1st of October it takes place, and I was in the process of closing on this house with an FHA loan, if that were to take place post-October 1st, I would not be getting that FHA loan processed, and it could cause issues with essentially the closing on the house. And so very fortunate to have gotten this done before the potential shutdown, but it really opened my eyes to how when departments shut down, it isn't just the individual workers, as you mentioned, right, and people actually working in that department that get affected. It's also, a lot of people that utilize those resources or areas of the government, and, whether they should be there or not, that's up for debate. Everyone's own opinion on that stuff, but at the end of the day, it does affect more than just government workers when the government shuts down.
All right, here's the other side, Mike. It's from memory. I don't know if you remember any of these, Mike. There's not much of a market reaction. I mean, I feel like in 2014, that was when President Obama was in, volatility went up. The markets kind of went, they sold off. But I don't know. I think more often than not, somebody blinks, the last second they come up with a deal. They're like, oh, we'll sign a continuing resolution, which means we don't do a budget. We just kick the can down the road. I don't know. I'm not sure this is going to be that big of a market impact, but I could be wrong. Mike, what do you think?
Yeah, they're like you said, they're usually pretty short-lived. Looks like I'm reading there's been 14 shutdowns since 1980. Sometimes there's a partial shutdown. Sometimes it's a full shutdown. Last full shutdown was in 2013. But yeah, like you said, they're typically pretty short-lived. No one wants the government to be shut down. And generally, the market doesn't react too much to it because it works itself out.
So 2013 is probably the one that I'm remembering because that would have been President Obama. And I do remember there was a vol spike. It wasn't crazy, but there definitely was I wouldn't call it a big sell-off. No, I should have looked that up. We'll look that up for next time. So I guess the other thing that is on a full shutdown, we wouldn't get things like GDP. We wouldn't get employment numbers, right? I respect they would not come out. It was a full shutdown.
Right.
So could be a little bit of an air pocket on information. So I don't know, Shane, I know you probably weren't in the markets in 2013, but sometimes these are built up as big deals. If this is just a quick, all right, we're going to go 1-2 days and then we're going to go, and they'll come up with some continuing resolution. Big deal, no deal. What do you think?
Right. Thinking logically and not with emotion, it doesn't make sense for the government to stay shut down. It just doesn't. And if you're betting on it staying shut down for an extended period of time, you're sort of that's not a bet I would like to make. As you guys were talking here and I started thinking more and more about it, it just sounds like another excuse to inflate volatility, to sell it back down again. Obviously, this could be different this time, right? But at the same time, like Mike said, this almost always, the wrinkle irons itself out, right? Within a few days to a few weeks. And I wouldn't be surprised to see this clean itself up in a short amount of time, nor the market really freak out. And if the market sells off, let's remember, the market were to sell off during a government shutdown or a pullback even, that doesn't necessarily mean it's 100% correlated with the government being shut down, right? Correlation doesn't always equal causation.
All right. So, look, we'll see what happens on this. We'll see if it's a big deal, no deal. My guess is they come up with some continuing resolution, but maybe not. And this is a long time ago. This probably was 2002, maybe 2003-ish. Might have been 02. Maybe it was 01, actually. Might have been 2001. There was some sort of a shutdown, and there was no tax on airline tickets. So it was kind of cool. Like all those fees that you pay, there was no fees. So I remember that. All right, let's go to GDP. GDP's second quarter came in at 3.8%. That was above expectations. I don't know if you guys saw this, but let's see, the GDP Now model came out at a seasonably adjusted, where is this? 3.9% was the latest prediction. And I bring this up because, okay, we have 3.8 in Q2. The Atlanta Fed GDP Now model says 3.9. And, let's see if where that comes in, the closer you get to the end of the third quarter, or, the better the data is. But it would be surprising if it was that far. I mean, look, there's going to be a deviation from the Atlanta Fed GDP Now. But when I look at what the Fed is saying, and I look at their economic projections, this was September of 2025. The change in real GDP was expected to be for full year 2025 plus 1.6. Well, we just had a 3.8. Atlanta Fed GDP says 3.9. So, Mike, I'll go to you first, but my thought is this is why people sometimes get worried about a lot of stuff, and maybe it doesn't wind up coming to fruition if you're a bear, because we haven't seen really big inflation. I don't think the rate of inflation is going down now, but it certainly hasn't shot up. And everybody said this is going to be horrible for GDP. Well, it actually hasn't been, and I'm referring to the tariffs. But look, this is pretty good economic growth, Mike.
Yeah, inflation has seemed to at least somewhat stabilize, right? So, maybe it was a more conservative estimate on the front end, and things have sort of worked out better than anticipated amid the tariffs.
The fear was that it was going to eat into growth, and that inflation was going to skyrocket, and it was going to cause a lot of economic problems. The people who are on that side are saying, well, it hasn't happened yet. Wait till we get it all filter through the data, and it takes a while to filter through the system. But real GDP, or the Atlanta Fed model, is taking actual data that's coming in piecemeal and sort of making some estimates there. And so far it hasn't come out. Like if you were a bear and you were shorting the market on that side of it, so far that trade's been wrong. Now, we'll see what happens. I'll let you know when I know. But Shane, I think this comes back to, what do we keep saying? Shut up and take the gains. It's a lot of people made some predictions, but so far it hasn't really worked out.
No,
Shane, what do you think?
No, it hasn't. And I also think this is going to go back to, hopefully the microphone caught it and my connection wasn't lost when I said earlier that correlation doesn't always equal causation, right? If a government shutdown happens and the market goes down, that doesn't necessarily mean that the market went down because of that. Likewise, if GDP goes up and the market goes up, it doesn't necessarily mean the market's going up because of GDP either. In terms of the bigger picture, I think something that a lot of people fail to remember is the amount of foreign money that is coming into the U.S. markets, right? Either long-term debt instruments, equities. There's tons of inflows we're seeing this year. I think the Treasury made a comment about it in July. We're seeing billions of dollars come in outside of the U.S. to invest in U.S. markets. And so that's not to say, I know, Derek, we talked about Europe versus U.S. a couple months back when Europe was being really hyped up. And, at the end of the day, if you're bearish, it isn't just that you're betting against other people's opinion that live in the U.S., right? If other people around the world are bringing their money into the U.S., you're battling against that too. And those aren't inflows that are going to just necessarily stop at any time soon. And so it's really hard to make a bearish case without going off the rails right now. Into some crazy justification, it sort of feels like.
All right. So, yeah, I get it. And I think that's right. I mean, when you look at Europe, there was a thought that, okay, the U.S. dominance is over. Europe is now the place to invest. And certainly, I think it took everybody by surprise. I mean, like Poland, I think, was up 50% at one point. You had some of these countries up a lot. Developed Europe was up. Emerging markets was up. I mean, foreign markets have had some of the best years they've had, or the best, 9-month strung together, whatever I'm trying to say, in a while. So, I don't know. It's you're not early if you're saying I'm going to go into international, but international, you might remember, was it 2022, maybe it was 23. That was the trade. It's like, oh, it's so undervalued relative to the S&P, and it didn't work. And things like this sometimes work when people don't expect it to work. Mike, I mean, when you look at the market, and let's just go back to the Fed for a second. So the Fed lowers interest rates finally. Mike, do you remember how far it was in between? So they lowered now. When was the last time they lowered, Mike? Was that wasn't a full year ago, was it?
I don't think it was a full year, right? Wasn't it towards the end of last year?
Yeah, I think so.
Was it October? November?
October, I want to say.
I'm thinking you're on there. I think October. I think.
So it's less than a year, but the Fed lowered interest rates. Mike, I mean, are we getting more cuts?
I mean, it seems like we could. I don't know like how much it's really gonna boost markets though at this point. I think a lot of it's already priced in. I just don't see, another rate cut having a huge impact on the market here.
When I look at this, and I was saying to somebody today, this continues to remind me, and I did a whole podcast about how, is this the 1990s again? But it so reminds me of 94, 95, 96. And I said to somebody, I feel like we're in 1996 right now. And in 95, the Fed did rate cuts. They did a July rate cut, 0.25%. They did a December rate cut in December of 1995. And then they did a January 96. And, they did those 3 rate cuts. They actually wound up raising by March of 97. But, I mean, there wasn't the gap there. Well, actually, July to December, so that's basically 6 months. We just went about, what? Did we say October? We went almost about 11 months or so, right? Because we did it in September. So 10 months, whatever. Yeah, something like that. So I don't know. I feel like it reminds me of that. And a lot of people brought up that when the Fed lowers rates, sometimes the market performance after that isn't that good. Other people brought up, they never do this at a market high. Well, they have done it near market highs. But to me, we have this gap, and it's not like there's a big economic problem or the Fed was coming in to rescue the markets. So I don't know. I mean, this is why we hedge. This is why we buffer. We do all those things. We don't try and make predictions on the market. But it just kind of reminds me, and of course, everyone knows what happened 96, 97, 98, 99, 2000. I mean, 97, 98, 99 were really, really good years, despite the Asian contagion and the Thai bot issue. But I don't know, like Shane, I look at this, and I know I'm the only one on this call that was in the markets back then, but I kind of feel like it continues to be this 90s playbook.
I mean, you've got a lot of promising, tech and innovation going on to look forward to. And, you know, for the longest time growing up, I was always, oh, you're never going to find another Apple, right? You're never going to find another Amazon. I don't believe that. You know, things evolve, times change. And so, you know, there's a wide variety of industry subsectors that are forming right now and evolving. It's not just AI, right? And AI is sort of all encompassing. I don't see how this is done anytime soon. And, you know, I'm more of the belief, I've always wondered, like, what happens when we finally get there and AI's doing what everybody has been saying for the past year or two that it's going to do. Maybe that's when we see some pullback or profit taking. But at this moment in time, all you're seeing is people pouring more and more investment into R&D. And so I don't see how this is slowing down, I guess you could say.
Well, I mean, the bear case on AI is that it's over-promising and it will under-deliver. And at some point, the spigot runs off on the investments. Now, the other side of this is I went through the internet boom and bust, the dot-com era. And back then, I mean, a lot of those companies, you had new entrants, you had companies that were public. They had little to no earnings. You had
Pets.com.
Well, yeah, sure, Pets.com. By the way, Pets.com, if you read up on that case study of about that company, it was really interesting because there are companies today who are making a lot of money. Like Chewy is a pet store that's online.
They were 20 years ahead of their time, and it's incredible to think that.
Yeah, I mean, a lot of the things that are available now, cloud computing, the distribution network of delivery, all that stuff. But yeah, I mean, I don't know. I just feel like there's so much that's similar to me, and it's just a feel. And maybe it comes to pass, maybe it doesn't. But it just really feels like the late 90s. I was talking to a dividend manager today, and we were kind of talking about that and then what happened in the next couple of years. So, all right, let me flip to volatility. So, Mike, some new data came out today. Who is this by? I need to give them credit. It doesn't say on the graph. So the chart is NDX single stock volatility versus the NDX, the NASDAQ 100 index volatility. I don't know what to make of this, but it's a chart of the ratio of the 3-month average single stock volatility versus the 3-month average just index volatility. It reached kind of the same high level as it did. I'm going to say that's the end of 17, maybe 16 or 17. Mike, I don't know what to do with this, but I think it's interesting.
Yeah,
I mean,
it's interesting. I mean, I guess the takeaway is that there's a lot of there's news coming out that is individual stock specific that is moving single names more than the market, right?
And I don't think this is weighted, right? I mean, I don't know. It's there. It's not our chart, but it doesn't appear to be a weighted thing. So it's not like you can say, oh, the biggest names are responsible for this. But I think you're kind of pointing out that, and it really goes to the single stock risk too, right?
Yeah, exactly. I mean, we know that there's, when you own an index versus a single stock, with an index, you have that single stock risk spread out across, multiple companies. When you own one stock, you have that risk that something could happen, good or bad, that specifically affects that stock and, creates more volatility. That's why generally, a lot of individual stocks have higher option premium, more option premium than an index might, because, there's more risk and on the flip side, more upside when you own an individual stock versus an equity.
When we look at this too, and all three of us are involved in running a concentrated stock strategy, and that just means advisors, they'll utilize our asset management offerings to sell volatility on individual names. So maybe somebody worked for a company, or they bought a stock many years ago and they wind up with all this stock with a low basis, and they're trying to generate extra income or hedge it. We do a lot of hedging too. And I feel like there's been ample volatility in single stock names. And Shane, I don't know if you've noticed that too. I know you're trading all the time. Mike is trading it. I trade it too. But I feel like if you want vol, if you want premium, it's available right now, even though the VIX isn't that high.
Yeah. I don't think that would be possible. I don't think yield max could exist, and these other funds that do these in the form of ETFs, right? I don't think these things could exist if that vol didn't exist, right? And we've seen for quite a while now that volatility, it's really become more of an asset, or an asset class, if you will, or a tradable thing than just, something people are looking at and measuring to determine what their stock may or may not do, or their investment may or may not do. And I think that, it doesn't really seem like we're in any different situation or sort of game than we were. I think you said this was in line with 2017. I'll gladly remind you of XIV in 2018, the lovely credit sweeps product that essentially blew up, shorting short-term VIX futures. And then finally the VIX short-term futures caught a bid, and that whole fund, exploded. And so I'm glad you brought this up, because it's a reminder that sometimes it's not just an event in, the government or a company that might cause stuff like this. There are tons, hundreds, if not thousands of products out there trading volatility itself on individual names or indexes or other securities. And the trading within the volatility space can and has shown in past, events that it can affect the market itself too. If volatility explodes, the market typically gets dragged down, along with it. So, but it's interesting to see such large volatility levels in single names. I'm also not surprised, given the sort of space we're in with, again, the AI and all this tech that's potentially boom or bust.
2017, that was one of the least volatile years from, if you think about the VIX, if you think about implied volatility in the markets. And so when you're looking at a ratio, sure. And we have a white paper on our site that Jay and I wrote, where we compared the single stock risk. So if you own a single stock versus the whole index, I'll put a link in the show notes. You can go to zegainvestments.com. Of course, you can reach me at derek.moore@zegainvestments.com. That's Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments, you got to figure out how to spell that on your own if you want to reach me. But yeah, it's 2017, as I'm thinking about it, volatility on the index was so low, it probably makes sense that vol went higher. So yeah, we'll keep an eye on this. I don't really read anything from it, but going back, Mike, to what you said, I feel like there are the type of stocks that are in that index. It just seems like, yeah, of course, they're not going to get away with having a really low vol like the index itself. So,
yeah, Derek, can you remember a time where some of the largest companies in the index had volatility at these levels, with the index and these companies trading at or near all-time highs? I think it's pretty interesting that the biggest company in the world, NVIDIA, has the type of option premium it does, being as large as it is. Like, can you remember a time where there was a company, obviously there hasn't been a company this big, but a company that was the largest company in the index that was this volatile?
I do. I mean, it takes me back to early 2000.
Yeah.
But the companies in the index, like Sirius Satellite was the number one weighted company in the NASDAQ 100. Like, that was volatile.
Sure.
But Mike, I think you would agree, like, it's, I mean, NVIDIA is not Sirius Satellite.
Right.
So, no, it's a good point, because think about when Exxon and AT&T were the biggest companies, their volatilities weren't that high. I mean, they really weren't. I mean, in the 80s. No, it's a good point. I guess we could try and research that.
You're also looking at stuff that in the 80s seemed to be almost more value. I'm not going to call those value stocks necessarily, but to me, someone my age would probably look at ExxonMobil as a value stock relative to something like NVIDIA. You also got to probably look at investor psychology, guys, and the market itself, the accessibility of trading. Everybody can trade on their phone now, or buy and sell assets on their phone, with the, just a quick swipe. So it's a different environment. And the market making process and their relationship with the day-to-day function of the market. You guys know I love microstructure. That probably plays a big role in it as well.
All right, you're having a little technical difficulty there, Shane, for a second. But yeah, I mean, definitely the market structure plays a role in this. And Mike, when you asked me the question, obviously I wasn't around for all of these, but I'm going to have to refer back to Carlotta Perez's book, Technical Revolutions in Financial Capital. And maybe it's when you have these big sea changes. And it's so AI, you go back to the internet in 2000, you go to the Industrial Revolution, railroads, like all these different things. Maybe when you have these seed changes is when you see this. But then again, 2017, we just said there was really nothing like this. So I don't know. I'm going to have to research this. All right. Let's go to the worst performers this year. And the only reason I'm going to bring this up, I just thought there's a lot of stocks at all-time highs. A lot of stocks have done really well. What was it? Oracle is up something like 80%, or it was at one point. So which stocks have been the worst this year? And this actually speaks to why you index, why you do these. So some of the worst ones, the Trade Desk, down 60%. Who is this from? They don't have their logo on it, so I'm sorry, someone else did this work for us. Decker Brands, Lululemon, down 55%. I will tell you that, so American Express card now has you get 75 cents off, or $75 off every quarter. So I actually didn't know they sold men's clothing, but I bought something because I have a credit. So I'll let you know. I'll give you a review of that next week. So Gartner, Dow Incorporated, so that's the chemical company, not the financial company. So CarMax, FactSet, Moderna, Constellation Brands. I'm trying to Target. I'm reading some of these. Chipotle, UPS. So I just think it's interesting. Like, there are stocks that are down this year, and I don't know what's going on with these businesses. We don't do individual analysis, but first of all, Mike, do you own any Lululemon? Second, any surprises by some of these names on here?
Do I own any Lululemon stock? No.
No, like the clothes.
I know. I do have some Lululemon, actually.
I didn't know they made men's clothing.
Good workout
like
gear.
Okay.
Yeah. It's fine. I think there's so much competition in that space now. Everyone's making that stuff for men and women. It's probably way overpriced, and you get something much cheaper, but yeah.
CarMax, down 43%. So is this an indication that, you remember how used cars were so expensive, and maybe now they're not anymore? Maybe people are going to new cars. I have no idea. Or
I think Carvana would like a word. I think if you look at the performance of Carvana stock to CarMax, I'm really wondering. I don't have it in front of me right now, but I'd be willing to bet one's gone up and the other's gone in the exact opposite direction.
Moderna is not surprising, just because that was a stock that had run up so much, and we're kind of in the in the twilight of the whole 2020 thing. But then, all right, Constellation Brands, that's an alcohol company. Chipotle, I don't know. I mean, I eat there once in a while. Nothing really else to say about this, but
yeah, I don't know, Mike. I feel like I eat Chipotle less. I don't go to Target as much as I used to. It seems like most people aren't obsessed with Target like they used to be. Constellation Brands, most people my age in their 20s and younger, a lot less people drinking. I don't know if that's because they can't afford it. I think it's more so just a lifestyle choice. I think a lot of people aren't drinking the way they used to. That makes sense.
The Trade Desk, digital advertising technology, down 60%. I mean, here's the thing. I didn't do any research on this. I'm looking at the list. So these may have run up 200% for all I know, and then now they're just trading down. So, okay. Next thing on our list is Trend Labs came out with what they say are new market cap rules. So think about mega caps, large cap, mid cap, small cap. So let me know what you guys think about this. They say mega caps is over 200 billion. Large cap is 30 billion to 200 billion. That's crazy. Like 30 billion used to be mega cap. Anyway, mid cap 10 billion to 30 billion. Small cap a billion to 10 billion, and then micro cap down less than 1 billion. So yeah, probably it's time to redo these levels, given that NVIDIA is $4 trillion. So, Mike, anything? I mean, it seems like it's overdue. They probably good that Trend Labs did this.
Yeah, it does. It does seem overdue. I mean, the numbers have been getting quite large for some time. So eventually, you got to redefine these things. I mean, we're at unprecedented levels in terms of market cap.
I'm just trying to think. So NVIDIA, are they the only $4 trillion company? Or is Microsoft too?
And Apple, I think.
Largest market cap S&P. Do this on the fly here. Should have done the research earlier. Yeah, they're just so NVIDIA, Microsoft, Apple, Amazon are the top four. I don't know.
Apple looks like it's 3.8.
Yeah, NVIDIA looks like it's 3.8. Alphabet 3 or just under 3.
Microsoft 3.8.
But look, I mean, they're including Berkshire Hathaway. There's 9 companies that are over $1 trillion. That's
wow,
kind of a big deal.
Records are meant to be broken, right?
Well, sure. I mean, look, markets go up over time, so of course you're going to see this,
right? And I like that you pointed this out, because this is something that I think's underaddressed in our field, especially, is bringing things up to speed and up to date. Right, as markets evolve, we should probably be updating these groups and these names, numbers, all that stuff. So this is good.
I'm looking. What I'm trying to get to. No, it doesn't list all. Okay, next 100. No, I don't want this ad. I don't want that. I'm trying to figure out like where company 500 is from a market cap standpoint, and I don't know if I'll click through these. Give me one more second. I don't even know if this site is right, but they got the logos of the companies and everything. I don't have my Bloomberg on right now. So if I look at company 350 is 25.89 billion. And then if I go down a little bit more, let's see, number 500 is 15.21 billion. So according to Trend Labs, 15.2 billion, would be a mid cap. So the S&P actually isn't all, well, okay, by the old definition, it's large cap, but no, it's It's a mid cap according to the new definition, between 10 and 30 billion. So, all right. Last thing I had, and then we'll kind of go over a couple odds and ends, is Reventure had a chart, homebuyer demand versus affordability by state. So this is an XY axis, got a lot of dots on it. Each dot is a state. And the Y axis is home sales versus 2019 levels. And then the home value. So it's saying that home sales in expensive states are down 30 to 35% from 2019 levels. States like California, Hawaii, Massachusetts, Washington. So if you take, let's see, where is Illinois? Illinois is down, I'm going to guess, about 18% from 2019. And the home value is around 300,000. I don't think the values really matter. I think the point of this is the higher the value of the home, the more they are off from their 2019 levels on a sales basis. So not dollars, but just sales. So basically Louisiana, Oklahoma, Alabama are down the least, but those homes I guess this is a median maybe, is down the most. So actually, as I'm reading this, I'm not sure what value this is. It's just saying higher priced homes have less sales, which would make sense because given mortgage rates are higher, then Mike, anything to you glean from this? I guess West Virginia is the one.
West Virginia's positive.
Yeah.
Yeah. I mean, mortgage rates, right? It seems kind of straightforward. Like the more expensive the house, there's less people out there that have cash to, that amount of cash. If you're not going to use a mortgage, if you are going to use a mortgage, your payment is that much more than it was when rates were lower. So,
I mean, something about this too, it's telling me, are people moving from high cost states to low cost states and they're buying these houses, or just we see activity because the houses are lower? I mean, it's all relative. The reason why houses are lower versus higher and has to do with the median income and the cost of living and all that stuff. So, but yeah, I mean, and by the way, if you look at this, you say if the Fed gets on board and if we see that compression in the rates between the 30-year mortgage and the 10-year treasury back down to its historical normal median difference, that mortgage rates will come down and we'll see some more activity. But I mean, home prices aren't going down, Shane. They're just not. The number of sales has gone down, but home prices are not going down necessarily.
No, and it's really, I was talking to a buddy of mine about this last week. Real estate is so odd because it's affected by things at the federal level, interest rates, inflation and its effect on the cost of living, obviously, all those things. But at the end of the day, too, it's about your location, where you're at. If you're living in Florida, you got to worry about a hurricane every year, right? If you're living in Central Illinois, not so much. But if you live in Central Illinois, there might not be a ton going on economically beyond just local economy, right? So it's all relative to, where you're at as well. And, at the end of the day, I also think, Derek, we've done a ton of research on mortgages and all this data. Good chunk of people that own homes already have their mortgages paid off. A good chunk of people that are in homes right now probably aren't leaving them because they probably have rates lower than the ones that they're currently at. And so, no, I don't think the market's in a situation where you've got a flood of demand for buying homes. And simultaneously, I don't think that sellers are so it's not like 2008 where everybody's trying to sell their house because they can't afford it. People that are trying to sell their homes right now are trying to sell their homes to either relocate, they want to downsize, maybe some people even upgrading. It doesn't seem like people are selling homes because they can't afford them. And I don't know the data on foreclosures. They might be up, but I would assume that we're not, seeing a elevated level of foreclosures on homes relative to what we saw in 2008.
All right. Last thing I wanted to bring up was, I mean, we're coming into Q4, and before you know it, it will be the end of December, which is crazy, and we'll do our big prediction show for 2026. I was looking to see my prediction on the S&P 500 coming into the year. I said the S&P would end the year at 6,800, but I said the high would be 70.30. And what else did I say? It doesn't matter. We'll get to it on a prediction show. So I don't know. Predictions are rarely right, but there is a 22% probability, 21% probability that the market ends the year above 7,000 based upon the options market. And there is a 42% probability of it touching that. So you think about my prediction, which, by the way, doesn't mean I invested any different or we did anything different for clients. It's just, having a little fun with predictions and how they're useless, but people do them anyway. So I don't know, like 22%, what did we say? 42% chance that it touches 7,000. Shane, going to go to you first. We talked about this 2 weeks ago. Like, what is that now? That's only, how many points is that off? We closed at 66.43.70. So to get to 7,000, Shane, I mean,
56, 57 points, 357. You're talking 5%, and
yeah, it's 5.36%. That's it.
I think we came out to like somewhere between like 15 to 17%, something like that, up overall year to date to put us at 7,000. So, I mean, look, it's well within.
We were 4,900.
I know.
How low did we get? Did we go down to 40? It wasn't 4,900, but it was under 5,000, right? In April?
Yeah, it was bad. And it felt like we were on the brink there. And like we said, this is a very hated rally. There's a lot of dry powders and a lot of fund managers still parked on the sidelines waiting for this thing to pull back. I myself was guilty the first half of this year of waiting for that, especially post-April. And, at the end of the day, this market seems like the path of least resistance is higher. So I will say I remember attending that call before taking this role at Zega 2 months after that. And I thought you guys were out of your minds for thinking the market would go so high. And here we are. So.
Oh, you listened to the podcast. Yes, I remember that. Yeah. You listened to it and you were like, what are you guys thinking?
I did. Yeah. But, again, this is why we buy and hedge, right? You're never going to necessarily be able to predict the top. Good luck trying. You're probably not going to make much money trying to do so.
Mike, it's interesting. You and I were talking the other day about how relatively cheap hedging is right now. And we have some strategies where we buy puts or put spreads. And we call that the cost of hedging. Mike, it's one of those things where I feel like sometimes the market is at all-time highs and nobody wants protection. But I feel like people kind of want protection now, but there's also this segment that just hasn't, like, they can't believe it. They can't believe, like, that it's impossible in their eyes based upon everything that's going on. So one, Mike, talk a little about what you're seeing on the cost of hedging, and then, like, I don't know, it's 7,000 seemed far away, but it's 5.3%. So any thoughts, Mike?
Yeah, I mean, I was looking at some puts yesterday, and even with the market was down a little bit this week, but it's very cheap to hedge a portfolio right now. Like, if you want to protect a year out and 5% down, I can't see exactly what it is right now. I got logged out of our trading software, but it's very cheap. It's as cheap as I've seen in a while. As far as it going up another 5%, I mean, what does that put us at? Like almost 18.5%, 19% for the year?
Closer to 20 than 15, I think.
But that's not a crazy year.
No. Yeah, exactly.
Relative to inflation as well, correct.
Last few years, last year was up almost 25. Year before, up 26. 2022, we had a down year of 18. 2021 is up 28. 2020 is up 18. 2019 is up 31. So, yeah, very possible, and would not be some crazy outlier of the year.
You mentioned the cost of hedging. I'm still in our trading platform. And so, yeah, to hedge 5.2% below the market, it would cost an annualized return of about 3.9%.
Right.
Meaning, basically, you could buy the market with 96% of the capital, and then with 4%, you could buy the protection. Now, there's different ways that we do the protection, but a 10% floor in a portfolio, it's 3% annualized cost of hedging. Like that's pretty cheap. And
what'd you say before, Derek? Nobody wants protection until
nobody wants.
And by the time they need it,
people want it, but it's cheap. It's still cheap.
Yeah, right. It's a no-brainer. If you think the market's going to go up another 5 to 10% over the next year, and you can ensure that you can't lose more than 10% below where you're at right now, and it's only costing you 3%.
There's still people on the sidelines, though.
Of course,
and there always are.
There always will be. Right. I absolutely. If you don't mind, Derek, there was some big news, and I want your professional take. They might lower the pattern day trading flag from $25,000, the requirement for pattern day trading, to $2,000. Do you think that has any effect on the day-to-day to the market or the overall? Probably not long term, but day to day. Do you think that might have an effect? And we see volatility, like we said, in these individual names continue to increase because people are able to day trade at will as long as they have just $2,000 or more in an account.
Honestly, I don't think so, and here's why. I mean, think about, are we an institution? Not, I mean, yes and no. We're a professional asset manager and investment advisor. Like, some of the size that we trade is pretty large, especially in the options world. But you have huge companies. You have the Morgan Stanleys, the Goldman Sachs. My point is that these people are aircraft carriers, and they are the ones who are moving markets. I don't think that someone going in and out of stocks with $3,000 accounts is going to really matter, because the size just isn't there. Now, where it does matter is, and I remember before it was 25,000. Like, I remember in the early 2000s, I mean, people could trade all over the place. Certainly in late 90s. At least that's how I remember it. Like, I don't remember so I'm not sure it's going to be that big an effect, but it is a little bit of a rollback to, I think, where things were. I mean, Shane, do you think it's a big deal? I don't.
I actually think it's better for individuals trading in accounts that size to have the ability to take positions off intraday without being penalized. If someone's going to treat trading like gambling, they're probably going to lose all their money in the first place anyway.
They're going to lose all. I mean,
right. So realistically, the people who were going to lose their money are going to continue to lose their money. I think this, if anything, provides the smaller trader who is trying to properly manage risk a window to do so. And I'll be realistic. I have been in situations where I don't have a day trade in an account. Back when I worked at Schwab, I traded a lot on my own. And, if I didn't have a day trade, I might be down a couple $100 on something, up a couple $100, and I can't pull it off, right? I can't because I got to let it sit for a day. And having that ability, I think, again, it's better for the consumer, the end user. The people that were going to blow their accounts up are going to continue to blow their accounts up. And I don't think it's going to cause that much more vol. If anything, I think it might help dampen vol.
All right. I don't think it matters, but I get the context that you bring it up. And yes, do I think that people blew themselves up less because it was 25 versus 2000? No. There was a study, Mike, I don't know if you've ever heard of this study. It was in Brazil, and they followed day traders, and they followed them, the same people in the study, and something like 99.7% of the people, their accounts went to zero. I don't know if you ever heard of that study, but that's not surprising. Like, day trading is very, very hard. And I know it's glamorized in some of the movies and things like that. And certainly in the late 90s, 2000s, they used to call them the SOS bandits. But Mike, any thoughts on one, the pattern day trader rule, or two, just, I mean, do you think it matters? And is it surprising to you that 99.7% in this study blew themselves up?
No, it's not surprising. Day trading is very difficult. In my early days, I tried it. I had a go at it. It's very difficult to do. Not surprising. I don't think the new rule has really any impact on the market. I mean, great if they want to allow smaller accounts to have a go at it. But like you said, I think people that were going to probably blow themselves up anyway are going to, and the few and far between that are very disciplined in doing it, sure, it'll benefit them.
There is, with day trading, it gets into there's something called the risk of ruin, and it's a mathematical formula, and it looks at the average win, the average loss, your winning percentages, and it gives you a probability of the account going to zero. Bennett McDowell, which one of Bennett's books? He's been a guest on this program. It's been a while. I should reach out to Bennett. But he's got a book about trading management, and he talks about the risk of ruin formulas in there. And that's probably worth a read. If I can find Bennett's book. I actually should have him on again. He does Trader's Coach. I don't know if you guys ever heard of Bennett, but I used to have him on when I hosted the Market Huddle webcast at TD years ago. I'm talking like 2007, 2006. So, all right. I think we covered everything.
A trader's money management system: how to ensure profit and avoid the risk of ruin.
By Bennett McDowell. Yeah, that could be it.
A. McDowell. Yes.
Yeah, Bennett's good. Bennett's a good guy, and he was great. It was really funny when you host a show with guests every week. Sometimes people would cancel, or I would schedule them anyway. But he was one of the people I could just, call 20 minutes before we were going live and say, "You want to come on?" He'd come on. So, but yeah, that actually of his books was one of my favorite ones. But he talks about the risk of ruin in there. So that is for you traders, that's probably a good book to pick up about risk management. All right, let's get to the recommendations. Shane, let me go to you first. Any recommendations? And you get like one, maybe two.
You got it. I got one.
None of this 12 books.
No, you're going to get one from me, okay? And I just ordered it for myself and my father. My father is a big poker player. I enjoy poker myself. And I thought it fitting, given that I'm going to the CBOE's Quant Risk Management Conference next week. I'm seeing Steve Heston speak, the gentleman behind the Heston model, which is very popular in our field. And he has a book called Kill Phil, which is called Kill Phil, the Fast Track to Success in No Limit Hold'em Poker Tournaments. So I'm sure our foreign listeners will love hearing about Texas Hold'em. But
no, poker's worldwide.
I mean, it as it should be, right? So this is about Phil Rookie essentially trying to be as good as a guy who won many World Series of Poker tournaments, and it gets into the quantitative side of poker. So I look forward to reading it.
Yeah, no, I know you're looking forward to that conference, and our friends with the CBOE, they're hosting it, and that is you as a fan of a student of trading and the options markets and all that. There's a lot of math at that conference, so I think you'll enjoy that. Mike, any recommendations this week?
Yeah, I'm going to be watching the Ryder Cup this weekend.
Oh.
I think it's far and away the best event in golf. Even if you're not a huge golf fan, the Ryder Cup is different from your typical golf tournament. It's sort of like when you find yourself watching the Olympics and you're like really into a beach volleyball game. And if it wasn't the Olympics, you would probably never turn it on. I don't know. That's how I get for the Olympics, at least. But, the crowd is different. The crowd is loud. The players show emotion because it's for their country. And so that's what I'll be tuned into this weekend.
It is really different. And the fact that it's a team, I mean, there's individual matches, but it's sort of a team versus team. It's this different dynamic. I don't know if you've ever watched the documentary on the 1999 Ryder Cup when the U.S. And if you Google it, the golf shirts they wore were like a bunch of picture frames on their jerseys. I remember.
Is that the Justin Leonard?
It is. Justin Leonard hit the putt to win it. So sorry if nobody, you're going to go watch that on your own. But yeah, the U.S. won that one. And they were the European team was a force. They had Colin Montgomery but Payne Stewart was on the U.S. team, Phil Mickelson, Tiger Woods. But they came back from a huge deficit and they won on Sunday. So I remember that one. It's a great tournament though, for sure. But the Europeans,
I'm watching this putt right now. There's no way he makes this.
Yeah, he made it.
And he makes it. That's nuts. I was 2 when this happened. So I can't say I remember it, but I'll
what do you think
watch
about those
it as well.
shirts?
Thanks
Look at all the picture frames on there. What do you think of those? That's something. Yeah, that was a great tournament. Mike, I will say, though, the European team has our number.
Yeah.
I mean, they continually win, and, they seem to play better as a team. So even when we had Tiger Woods, like, I think they put him and Phil together, and it never really synced. I don't know. So
it's tough to win on the road, but I think if it's going to happen any year, I'm not hoping for it, but I could see Europe pulling the upset.
Bethpage Black, right, in Long Island? Yeah.
Right.
Okay. All right. I have a sell recommendation, and I did watch the Charlie Sheen documentary on Netflix. I'm going to put a sell on that. That's on my don't watch list. And I thought it was, I don't know. Look, it's 2 parts. After I watched, I was like, why did I watch that? So that's a don't watch. I do have a pre-recommendation, and my wife is watching a show on Netflix called Black Rabbit. It's got Jude Law and Jason Bateman. And it's a limited series about the owner of a New York City hotspot who may lose everything when he ... So there you go. That's my pre-recommendation. But I have a don't watch. So there you go. All right. We'll see if there's a government shutdown next week. We'll know when we know. And I guess if there's a shutdown, we may not get some data. So we'll see. Shane, Mike, thanks again for coming on. And for everyone else, we'll talk to you soon. Take care.